Okay, so as I mentioned, for today, I want to finish up making projections here for the Costco comp. And really the lesson here is going to be just reiterating how to seek out and dilute shares. We're going to lay it out. We're going to analyze it. We're going to go through a precedent transaction analysis and lay everything out in a football field. So we had done the Costco comp, done the historicals, made our adjustments, laid everything out to EBIT. And now we have other income. Things like this in a comp, I wouldn't really, maybe you can use the 7 methods to project this. I just took it from the last year, 2012, as you remember, we are projecting off of 2012. You know, we're going to have EBIT and EBITDA in our metrics. We're really not going to use this too much. We will have PE, so this will impact our PE metric, but not by much. It's not so significant. So I basically used the 7 methods and took the last year. Now, interest expense, whereas you remember one difference between a comp and a full-scale model, in depreciation, we didn't do a depreciation schedule, or I didn't recommend doing a depreciation schedule, although you very well could. You could also do a debt schedule. We never had to do it. So, you know, remember the idea of depreciation and interest. Depreciation should be steadily climbing as your business is growing. Interest expense arguably wouldn't drop unless you're paying down debt, or wouldn't increase tremendously unless you're raising debt. So I kept interest at the year before. It shouldn't change too much. If you want to add a second level of detail and build out a interest and debt schedule, you can, but I think for comps purposes that's overkill. But of course, you can get into as much detail as possible. This should shed some light on towards the end of the program where we're actually doing final round 8 case studies that you guys have given me. And you have to think about, hey, where do I start? Where do I stop? How deep do I have to dig into the analysis? This is analyst associate level thought process. And you kind of have to start thinking about where can I make some shortcuts, and you know, where do I get into detail in order to meet certain deadlines. So we'll start to get to that. And this is just one viewpoint on that. You don't have to have everything fully built out, and in some situations you won't have the time to do so. So how do you efficiently get an analysis done and get to an answer without getting lost, right? Because the point of the case study is to get to an answer efficiently as possible. And the lesson there is making sure you have the conceptual understanding of model building just to get to a high-level answer. Okay, so now we have earnings before tax. These total items we can just copy to the right. And for income tax expense, we'll just use the 2012 rate. We've been using 2012 stats. We'll use the 2012 rate. I pulled it in and calculated the tax. So this is just standard model building stuff. So try to get to net income of 1995.9 while I save this. Shut this down. And we're in the 29th. And for net income attributable to non-controlling interests, I'm going to use 3%. Oops. I'm going to use 3% of net income. So let me know if you have questions on that. I don't want to get into too much detail with just making projections. We are beyond that. Non-occurring events, I make 0 for projections. They're not going to go anywhere. And actually, our net, we can even probably just stop here. Our net income as reported, there is no reported net income. It's kind of trivial. All right, we're going to use the adjusted net income for our comps, for projections. You probably don't even need to put anything there. Right? This is where we stop. But just so you know, in case there's any questions. But we do need our EPS. And for our EPS, we need to make projected shares. So we need to project our shares. And so how do we project our shares? Where do we go first? Any questions on getting to 1931.2? Do you want to take a second? Anyone still working on that? How do we get to shares?
Well, the last 12 months.
We'll pull up, and in this case, it's what? It's actually the K. The latest K, the 2012 K, was way beyond, was September 2012. That was the most recent. So we're going to take the K, which was, I believe this was the one. And where do we get the most recent reported number of shares? The K, but where in the K? Very first page. The very first page would always display, this is the one, yep, September, would always display the most recent number of shares as of print date, which is even later than the reporting date. So you want to go right on front, and it says the number of shares outstanding as of October 5th was 432,424,379. So we're going to start there. Okay, 432,424,379. So I believe I have laid out already a box underneath. If not, we'll have to lay one out ourselves. Here it is. The diluted share calculation. Number of basic shares outstanding was 432,424,379. The front page of the most recently filed report. We also want to note the company's current trading value, which was $96.94 at the time. And we need to dig through the K to extrapolate any options, warrants that are outstanding and exercisable. They have to be outstanding and exercisable. So, do a quick word search for options as an example. And I'm going to do this quickly, but you have to spend quite some time making sure you found all the tables, all the option tables. In some situations, they might have several different tables. They'll have tables for outstanding external options. They'll have a separate table for employee stock options, a separate table for restricted stock, and you have to make sure that you're including all of that. In this case, they had laid it out nicely in one table. Which was not this one. Here it is. Number of options outstanding and exercisable. So you got to make sure outstanding and exercisable. Remember, in Walmart, they had an outstanding option table, and then only a subset of those outstanding options were exercisable. What was the difference? Why would a stock not be exercisable? Well, no, I mean, they'll give you the strike price, so that may or may not be the case. Yeah, vesting periods. They might have timing restrictions. Okay, so they got 3161 in thousands of options that are exercisable. So 3161000. You have to be on the same page in thousands because the 432 was reported in actual numbers. So be careful of the units. And what is the strike price of those options on average? I could have broken this down into 3 categories if I wanted to, but you know what? They're all in the money. They're all in the money. We're trading at 96. So it didn't. If you had a stock trading at 45, the stock trading at 45, and some were in the money and some weren't, then I would get into this detail. But in this case, since they're all in the money, I wouldn't even be concerned. 40.90 is the average stock price. 40.90 is the average strike price. And we then have to use the treasury method to dilute these options. Got it? So this is good practice in treasury method. In the M&A course, we'll really key in on needing to use this, because options dilute, stocks dilute when you acquire a business. So we'll get into that next week. The total option proceeds is the in the money, the number in the money and exercisable times the strike price, which would net us $129 million. Repurchased at $96 a share. Right, so of the 3161 exercisable, 1333 get bought back to complete the trade. And so the difference is the leftover diluted shares outstanding. The difference is the 3161 minus 133. So really become familiar with this. So what I had done was I had calculated option proceeds by multiplying the in the money times the strike price, and then divided by the $96, the current value, and then subtracted the outstanding options, the 3161 minus the 1333. And that gives me a diluted number of, you take the basic and you add the 1827 and you have 434251. So that's the diluted number. Yeah. Make sure you have that. I will send this to you, of course. You should poke through to make sure you know the numbers. Okay. These numbers of shares, anyone question on these? Want to look at some formulas? We will link these in to our number of shares outstanding in 2013, right? This is our comped number of shares. So for 2013, we will not use the year before. We will equal to and divide by 1 million, yeah? We'll equal to the basic number of shares that was reported on the front page divided by 1 million. So went down a little bit. Diluted, we'll link into the diluted share box divided by 1 million. Right? So it looks like there were some buybacks going on. We can copy over the EPS numbers, and these are the numbers we would use. Now, I would cross-check these EPS numbers with the street. Remember the idea. Remember the whole point is, and this is where sometimes comps analyses can be over-engineered. No matter how many tables we've built to get to this EPS number, this should be in line with what the street is saying on average, and you can find those average street numbers on Thompson, which links into Yahoo Finance as a first cut. So if we have revenue that's tying with the street, and EPS is tying with the street, then when I say tying is within the range, then great, we have a good analysis. If we have revenue that's tying with the street and EPS is much higher or lower, that must mean we are overstating or understating some cost assumption. Now, it shouldn't be depreciation if our depreciation is growing steady. It shouldn't be interest expense if our interest expense is growing steady, unless you've read that they have sold off some huge amount of assets or paid down a lot of debt or bought a huge amount of assets or raised a lot of debt, right? So that should be standard. So the only fluctuation then should come into cost of goods sold or OPEX, and now you know what to research for when looking at equity research reports or in looking at investor presentations or in getting on an earnings call or reading earnings call transcripts, is you're looking to see if they have any initiatives that have if they've announced any major cost-cutting initiatives or anything going on in the environment, in the market environment, that might increase their either COGS or operating expenses. And that's what you look for. Why is our EPS out of line with the street? And this is a good first cut way to get to a model and an EPS number that ties closely with the street and have some good meaningful backing behind it. And as you, of course, get to know the company yourself, and then you can start branching off and making your own tweaks and having a street case, having your own case, an aggressive case, conservative case. We'll do those in the M&A and LBO courses. So these will be the underlying numbers to be laid out in the comps model. Before we do that, though, I do want to calculate the market cap and the enterprise value for Costco. So under here, I have a market value and enterprise value, a box where you can calculate market value and enterprise value. You should have this for every comp, where market value is simply the number of shares outstanding times the price per share. Oops. And we want to be on, I believe I divided by 1,000 to be on, sorry, 1,000,000. To be on the same pace as the other comps. See, they're reported in millions. And we do everything off of the diluted shares on a diluted basis. And then to get from market value to enterprise value, we want to look at what debt balances they have as per the most recent filing, which in this case is Costco. So here is the notes to the statements. The notes always come after the core financial statements. Cash flow, income, here's the balance sheet. So, what do they have? They have cash. What other types of debts do they have? They have current portion of long-term debt. There. Long-term debt, 1381. I think that's all they have. Oh, non-controlling interests, 157. So we need to lay all of that out. And cash, of course. So here in this table, they lay out all the different options. Short-term debts, they actually don't have any straight up short-term debts. They have current portion of long-term debts. I laid that out here. Long-term debts includes current portions, which I'll just hard code in as equal to the long-term debt was, the current portion is $1. Long-term debt is 1381, so that's 1382. No capital leases, no convertibles, no preferreds. They do have minority interest, which was 157, non-controlling interests. Same thing, 157. And less cash and equivalents, which is negative at the top of the income statement, 3528. 3528. And so the sum of everything, of course, is their enterprise value, 4107. Important to lay it out like this. I know some people in the comps table just do it right in the comps table. I always recommend to lay it out explicitly like this so you can go back into where it's coming from. Okay? You guys okay with this? Okay. All this gets linked into the comps analysis. So if you go to the comps analysis, the comparable companies analysis, you will note a lot of it's already been laid out, right? We don't want to have to build the whole comps analysis, but except for Costco. So notice the way I like to do this, and this is the way that was recommended doing it when I was at Morgan Stanley, is there are two tables. There's the actual multiples, and then the underlying data that supports the multiples. The reason why we separate it like this is because there's a lot of errors in the division if you're linking back, messing up columns and things like that. And you can, as an associate, you can kind of eye this and see what multiples are out of whack and say, well, does this make logical sense? Revenue multiples should always be consistent, 1.3, 1.2, 1.2. If you saw 1.3, 2.4, 1.2, then either their revenue got cut in half, which doesn't make sense, or you linked it up wrong. So easier to say, all right, well, did the revenue really get cut in half? Let me look at the underlying data. So this is great in error checking, and it's great in error proofing yourself, because there's a lot going on in linking data in and then dividing. Better to link data in one table and then just do one division formula and copy the division formula crossing down. It just is one other thing to do to avoid possible errors. So that's the way I like to do it. So underlying data, operating stats, underneath the table of multiples. So Costco, we obviously have laid out our statistics in the income statement. We now want to pull it in. So we have sales 2012, which is again the adjusted 2012. It's not the 2012 that Costco reported, but it's their implied information based on Walmart's timeline. LTM is not actual LTM as per Costco's timeline. It's the LTM that's been adjusted to be on the same timeline as Walmart's. So we're going to pull in Costco's revenue, which comes from the top. Adjusted 93,097.1, and we could just copy to the right twice because the right two columns contain LTM in 2013. And you can do the same for EBIT, D&A, and EBITDA. Right? EBIT is going to be pulled in from the Costco comp. EBIT 2012, the adjusted, copy to the right twice. So you can see if I went up here and clicked over and then came back and divided and clicked over and came back and divided, there's a lot of chance of error. In this case, it's a bit more linear. D&A. Now D&A could have just subtracted, but I'm going to pull in D&A from adjusted, copy to the right. Right. EBITDA. I could pull in from the adjusted, copy to the right. And EPS, we want the adjusted diluted EPS, which is what we had done last week. Adjusted diluted, copy to the right. And with this information, we can create our multiples and then analyze the table. Everybody have that? Yes.
But if you got modeling, can you get just the
You could have done that, yeah. And I had mentioned briefly when I said I could have subtracted to get D&A. That's kind of what I meant. You could have just pulled in EBIT and EBITDA, and this been a formula of EBITDA minus EBIT, or you could just pull in D&A and have this be, yeah, I could have saved a step. Yep, good point. Good point, good question. Okay, any questions? Okay, and then we can now pull in market statistics, which we have in the tables underneath. The current stock price we have from Costco Comp in this table down underneath. Market cap, pulled in from the Costco Comp that we calculated in the tables underneath and have already been adjusted to be in line with the units of the other companies. And same with enterprise value. So we're just linking things in. I don't want to spend too much time linking things in, but let me know if you have questions. And then you divide your metrics, right? Price to earnings, stock price divided by 2012 EPS that we pulled in, stock price divided by 2013, stock price divided by 2014. So I'm going to anchor the reference to the numerator, but not the denominator, so I can copy this to the right. So again, I always see a lot of errors with stock price divided. There's 4 EPSs on the Costco statement. Here it was easy. We linked it in once, and then we copied to the right. We know we're consistent. But I always see if you're doing this quickly and it's late at night, and you're doing share price divided by, and you switch to the page, you come back, and then here, share price divided by, and switch to the page, you come back. Maybe you're pulling the wrong ones, and I always see that happen. So, share price, 96.14. Anchor this. And what I could have done is, honestly, I could just take this column and copy the whole thing up, right? That's another convenience here. These formulas are set so you could just do it here, just copy it all the way down. You don't have to do this for each company, right? If you have everything pulled in here properly. Right? But anyway, divided by the EPS for Costco, copy that to the right. Okay. Yeah. And then enterprise value, again, anchor divided by revenue. So this is pretty self-explanatory at this point. And let's analyze this. Okay. Enterprise value divided by EBIT. Oops. And enterprise value divided by EBITDA. So take some time. What does this mean? What is this saying? What's the purpose of this? What are the benefits and the flaws? A lot of questions. A lot of questions to answer. Yeah, Daniel.
It helps us get a sense of the company within its competitive set, where it stands on several metrics.
So Walmart is the highlighted column, and we're analyzing how its competitors trade with respect to Walmart by looking at its multiples and trying to look at it on a comparable basis, comparable in terms of timing and comparable in terms of types of operations. So I mean pulling out non-recurring events and things like that. And so then what is it saying? How can you interpret this? And there are several ways of interpreting it. How can you interpret this? What do you think? Yes, AJ.
So we just look at the median. Those metrics down there.
You can look at those metrics down there.
See if where Walmart stand, under or over.
Yep. So you can look at Walmart's metrics, yeah, in relation to its competitors to determine whether it was overvalued or undervalued. And then how would you interpret that? How would you delineate that? So looking at PE, what would you determine in relation to PE, to the PEs? Would you use PE? Would you use enterprise value revenue or EBIT? How would you think about that? So for example, and we talked about this in the very beginning, we got PE multiples. Some companies are more comparable on PE multiples. They could trade better on PE multiples. Some companies trade better on enterprise value to EBITDA multiples, right? How would you know, and why would companies trade better on one versus the other? What are the differences? PE and enterprise value to EBITDA. So one extreme versus the other, yes. Okay.
PE is going to be a big factor in its capital structure.
Yes.
So at least with EBITDA, you take out that difference among companies.
Right.
With PE, it's not really comparing apples to apples.
Right, yes. So PE in some companies, so PE takes into account the impacts of the capital structure, right? You're comparing the stock price, which investors set after lenders have been paid, to earnings or net income, which is a number after lenders have been paid, after interest. And so companies that might have varying capital structures might not be comparable to each other. So that's why you might see major swings in looking at PE multiples in companies within the same industry, but you won't see those swings in enterprise value to EBITDA. And here's a good case. So you have Costco has a very high PE multiple, and then you have the company underneath this Target, I think, that has a much lower PE multiple, about an 8-point spread. You kind of want a 2 or 3 point spread. Whereas on EV to EBITDA, they're a lot closer, 7.6 to 9.7. And the reason why they're more in line on an EBITDA basis is probably because one of these companies has a heavier impact based on interest expense. So if you want to just compare the operations, I don't care about the interest expense and the debt and things like that. Maybe I'm going to buy the company and wipe out the debt anyway, whatever the case may be, you'd look at EBITDA. And more often we'll look at EBITDA. Now, when you look at Walmart in relation to this, would you say Walmart is overvalued, undervalued? How would you determine that? What is that? What would you think? How can you articulate what's going on here? How does Walmart look in relation to its competitors? Overvalued, undervalued? Yes, Sammy.
It seems to be somewhat accurately valued.
Okay.
Within the range, and if you look at the median EV to EBITDA, I mean, it's basically the same thing.
So what is the range that you would imply when you say well in the range?
So, I mean, the range is 7.6 to 10.2.
Right.
But the 10.2 is basically an outlier, and everything else is within the 8 range.
Sorry, where'd you get 10.2?
Oh, sorry, I think that's wrong here.
Or you just kind of, yeah, well, okay. So if and then you can look at 2012, 2013, you know, yeah, but it's about 7.6 to 9, 10, and Walmart is around 8 to 8.5.
Yeah.
So they're at the low end of the range. Well, low end to midpoint. So how would you conclude that? If Walmart was at like 4, then you'd clearly define that Walmart is undervalued. Or what? What's another way to look at that? Yeah.
Walmart's right.
Yeah, the industry could be off. All the other companies are overvalued for some reason. If Walmart was at 24, then Walmart would be clearly overvalued. What is a flaw with this analysis? That's going to kind of give us pause and say, well, let's look at some other analyses too and cross-check it. Well, always two sides to these valuations. What's a potential flaw you can think of? Big one. Yes, Daniel.
The comps just aren't good.
Yeah. Yeah, these might not be. I mean, well, first of all, Walmart, it's tough to find competitors to Walmart, first of all. And we had openly said when we ran this, I mean, even its next closest comp, Costco, and this should be sorted by market cap, it is, okay, is $200 billion smaller. So these might not be the right comps. Although Walmart does trade in line with this. So right now this is basically saying Walmart trades more or less in line, maybe a little bit at the lower end of the average comp range, which should mean it's within the comp range, but it can trade as high as 11, or it can go down as low as 7.6. It's almost around at 7.6. So what we want to do is we want to, first of all, in valuation, you always take a range. It shouldn't be a wide range, shouldn't be wider than 3 or 4 points, in my opinion. And you take that range and you use that range to establish an estimated value for Walmart. If Walmart was trading at the lowest end of its competitors, where would its stock price be? On the other hand, if it was trading at the highest range of its competitors, where would its stock price be? And we would assume, based on this analysis, that it shouldn't go outside of the range of its competitors, unless something major happens to the company. So we will lay out this similar type of thought process analysis for each of the 3 methods in our kind of football field, they call it, analysis, where we lay out the high, low of each. So for example, the comparable company analysis we estimated was trading around, I think we said a low of 7.6 and a high of, let me just look at what I ended up doing in the book because it's a little bit subjective. I did 8 to 11 because I just rounded it from 8 to 11. That's fine. About 8 to 11. So I did a low multiple of 8 and a high multiple of 11. You could have done 7.6 to 11.2 and been completely accurate with the dots. You could have taken the actual min-max. You usually just kind of subjectively eyeball it and round it 8 to 11. If Walmart is trading at 8, what would its stock price be? However, if it was trading at 11, what would its stock price be? So I'm going to take the 2012 Walmart's 2012 EBITDA and back into what its enterprise value would be if its multiple is 8, and then what its enterprise value would be if its multiple is 11. How do I get the enterprise value? I multiply the multiple by the EBITDA. So I'm going to do this on 2012. I could have taken 2013 EBITDA, I could have taken LTM. Just pick one, but you got to be consistent throughout all the analysis at this point. So I'm going to pull in the 2012 EBITDA. I have it in the operating model. I have it in the Walmart comp. Here's the 2012 EBITDA. 34688. And if you multiply, you will get the implied enterprise value for Walmart. Right? So I'm slowly building up back towards the stock price. Okay. That's the enterprise value. And then I want to go from enterprise value to equity value, so I add net debt. Now I know I probably would have had already calculated the net debt in the Walmart comp. Walmart comp, do I have the net debt? I'm sure. Here it is. Short-term debt plus long-term debt plus capital lease obligations. Just adding, I guess I could have done a big sum formula. I don't know why I didn't. 51551. Actually, the timing's off. I want, if I'm using 2012 EBITDA, I should actually get 2012 net debt. The net debt I just pulled was as of their LTM, their most current. So if I were to use this net debt, I should have used the LTM EBITDA. In the book, I didn't. I took the 2012 net EBITDA, so I got to take the 2012 net debt, which I can get from the Walmart's operating model. So that's a tiny, tiny, tiny difference, but good to have that level of accuracy. So if I go to the balance sheet and I go to 2012 and I take the short-term borrowings plus long-term debt due within a year plus capital leases due within a year plus long-term debt plus long-term lease obligations plus redeemable non-controlling interest. Actually, I think I had this on the DCF, didn't I? Plus non-controlling interest minus cash. We've already calculated this in the DCF analysis. 51727. It's about $200 million higher. Not a big deal in Walmart standings. And so the equity value is a sum. Yeah? And that number, if you'd remembered, we calculated that together actually when analyzing the DCF analysis, 51727. I kind of just pulled it from there. Because we used 2012 information for this DCF. Oops. Okay. So we'll pull in the latest reported shares outstanding and divide to get the share price. So we can go to our DCF analysis now that I remember that everything's in there. Get the share count that we had used to analyze the share price there, and divide it to get the share price, $97.82. And we'll do the same with the high multiple. Pull in the same EBITDA and multiply it. Say, all right, well, if Walmart's trading at 11, what would its enterprise value be? Add back the net debt, the same net debt, divide by shares, get the share price. Right? We'll do that for every analysis that we have here. So we'll take 2012 EBITDA. I'll just pull it from the left. I'm not going to recalculate it again. I'm going to multiply. I'm going to pull in the net debt. I'm going to add. I'm going to pull in the shares outstanding, and I'm going to divide. 97 to 128. Pretty high. Yeah? Questions on that? I need to subtract equity value. I thought that looked high. Right? We're going backwards, of course. That makes sense. Sorry. Equity, of course, equity value plus net debt is enterprise value. Enterprise value minus net debt is equity value. I can't believe I did that backwards. Sorry. I caught it in time. I thought that share price was high, right? Enterprise value is higher by equity value, of course, because of the net debt. So just, I told you equity value was enterprise value plus net debt. No, equity value minus net debt. That makes a lot more sense.
Well, do we have to also add back cash and cash equivalents?
It was in there. It's part of it.
Oh, I'm sorry, net debt. Yeah.
Yep. Any questions on that? Okay. I also like to, and we'll do this for the precedent transactions, we still have to do precedent transactions, and for the DCF. I like to track these against the company's 52-week high-low stock price, just because we're going to lay this out in the table with a bunch of floating bars to kind of see and to kind of try to see where they all overlap, which would help us determine a value. And it's nice to also look at where the company's stock has been over the past 52 weeks. So if you go to Yahoo Finance, you can go to Yahoo or any Bloomberg, it'll tell you the 52-week high and low. And at the time of putting the book together, the 52-week high and low was at $56.26 for the low, and the high was $77.60. Remember when I mentioned to you, I picked Walmart because they're trading at 56. And all our analyses pointed to values that were way over 56. So I said this is a no-brainer. But then as I started to, when the book was in the editing process, things like that, the stock already jumped. So there goes the conclusion that it was undervalued. But at the time, when it was 56 and the whole analysis pointed to the lowest was like 70, great case, right? Definitely a buy. But when the book was finished and the stock was at 73, suddenly it was a little bit up in the air. Was it going to go up a little bit? Was it going to reset back to the low 60s level? And that's where it kind of gets. So my point is, there are clear buying opportunities that you'll see when everything points to an increase. There's most of the time you'll see opportunities where the stock is kind of right in the range and it's appropriately valued. It can go up or it can go down based on headline risk, based on earnings announcements, and those are kind of hold and watch situations. Or there's situations where your analysis points to clearly across the board the stock price is much higher than where it should be, and those are sell opportunities. So you got to look for those situations. Okay, we're now going to do the reverse of what we had done with comps, and we're going to back into the multiple. What's the implied multiple based on the stock price? So we're going to pull in the shares outstanding, and we'll multiply, right? Share price times shares outstanding is the equity value, of course. And now we add equity value, plus net debt to get enterprise value. And then we divide enterprise value by EBITDA to get the implied multiple. So at their 52-week low, they were down to an implied 6.9 times multiple. Way under the comps range. Well, not way, actually not way under, right? I think the lowest comp was 7.6. It was under. And at their high which was, so at this time, well, no, I guess, right. At the high, it was at 73. So they were kind of around their peak. The shares outstanding, you multiply, add the net debt, and then you divide. This is kind of where they're at, 9. They're at 8.6, I think. We calculated it to be 8.7 on the DCF, remember, so around 9. Okay, let's take a break and we'll do the precedent transactions. We got to actually do the analysis. So I'll give you a second to catch up on this stuff. So the precedent transactions analysis looks similar to the comps analysis in terms of we're ultimately getting multiples, but the multiples come from a different perspective. The multiples are not based on market statistics, but based on purchase data. So the difficulty and ultimate drawback of a precedent transaction analysis is the ability to find comparable acquisitions and to find the underlying data for those acquisitions. But we're able to find this whole set, and one clue into that is if you find one acquisition, then go to that company's merger documents. And in those merger documents, and we'll talk about this in the LBO course, there will probably be something called a fairness opinion. I think you guys are doing a fairness opinion. Someone do or is it the summer? I think it's the summer guys at fairness opinion, which is a third-party advisory analysis on the approval of a merger or acquisition. So you have a banker would advise a buyer in favor of an analysis of an acquisition. A banker would advise the seller. And the thought process is always that the advisor to the buyer is in favor of obviously the buyer's interests, and the advisor to the seller is in favor of the seller's interests. So it is often requested to have a third-party, unbiased valuation analysis. What is the value of this company if there are no buyer or seller interests involved? So you would find this in the merger document. This is requested so that shareholders can get adequate information to approve on the merger or not. And this would contain their own set of comps and their own set of precedent transactions. So here's a good clue if you're kind of stuck with comps or prepaids to look for a fairness opinion in public filing. And we'll dig into that in more detail in the M&A and LBO course. Yes, AJ.
What SEC document that you?
It's there'd be an S4 or a proxy. Yeah. Most likely a proxy document, which is a solicitation document soliciting shareholders to approve on something, most likely something transaction. So you look for a proxy. And so the first thing you do is do some news runs, Google around. Precedent transactions should be acquisitions of companies that are similar to the one that you're analyzing. The price paid, the price that another company would pay for a similar type of business should indicate the price that your business is worth. So when I Google around for kind of acquisitions of big box retailers, one of these companies came up. I forgot what it was. I think it was maybe the KKR Dollar General. And then I went to, and I looked at the press release, and I looked at when that acquisition happened, and I went to companies. I typed in Dollar General, and up came a bunch of reports, and you look for, here's a proxy. Additional definitive proxy soliciting materials. Proxies are here. Defined by DEFA 14K, proxy, or 8Ks. And I spent, so when I found the press release for this transaction, the acquisition of Dollar General by KKR, I wanted to look for the underlying data to calculate relevant multiples. I realized it was dated. The acquisition was 7/6/2007. So I Googled Dollar General. They're now public again. So I had to type in prior to announcement date, 2007-07-07. All this came up. I spent a few hours opening up every document until I found one that had underlying financials most recent to the announcement date, which is an 8K, June 18th, and I knew this is an important document because right in the beginning it says this document is in relation to the transaction. This is a merger by private equity firm, or they actually say funds affiliated with KKR, but for all intents and purposes it was KKR, so I knew this is a transaction. They had sources and uses of funds, which is one of the first steps to a transaction is sources and uses. We'll learn about this next week in M&A. This sources and uses contains the purchase price paid, the debt assumed, great for getting us applied equity and enterprise value. Next question is, are there underlying income statement statistics where I can get revenue, EBITDA, things like that? If not, I'd have to go back to Dollar General's public filings. And there was. There was a balance sheet. Everything was there. So good. Here's income statement. Yes, Sammy.
Is there a particular time frame you're looking for? Because, for example, with this one here, the acquisition happened in 2007. Since then, there's been financial crisis. Things are not exactly the same. So do you take that into consideration as well?
Yeah, that is one major drawback to precedent transactions. They're usually dated after the financial crisis. M&A activity was really, really low. We couldn't find anything after the crisis. So basically, that's why another drawback is this analysis, the precedent transaction analysis is dated and historical. And the market environment is different now. So a lot of times they just throw this analysis out the door. It's not relevant. It's the best I can say. But important to know how to get that information, how to dig up that information. So that's why we're going to go through it. Yes, Brian.
Given that this earlier taken, why is it then still kind of useful? Just double check to make sure you kind of range or not range?
Yeah, I mean, and it's considered in the hopes that it won't be as dated as this one was. I mean, you wouldn't use it if this is what, 7 years dated. But if it's a year or two.
Time range that's a good range so we can find something?
Yeah. I mean, it's really subjective. I mean, you don't want it to be beyond 1 or 2 years. Obviously, the more recent, the better.
What's the best resource for finding things like this? Because in the past I've used Merger Market.
That's good.
That
Yeah.
requires a subscription.
Yeah.
It's
Yeah.
cheap. So is there like free resources that you can use for this?
Even the deal, I think you got a subscription to get the M&A activity. So for non-subscription based stuff, Bloomberg is great for that. You would just do news runs. So Google, and then look up, at least if you find one company, find their proxy document and find their P page. That's what you would do. Okay, so process. Now we want to get market value and enterprise value, and the market value in a precedent transaction is the purchase price paid. The enterprise value is the purchase price paid plus any debt assumed. So a lot of times when you buy a business, we'll talk about this in M&A, you're buying out the shareholders, but then you're also responsible as the acquirer to pay down the target company's debts. If you are responsible for that debt, you need to raise additional funds to pay down those debts. The debts assumed and absorbed or paid down gets you from the implied equity value to the implied enterprise value. Yes, Daniel?
So you're just going to use the purchase price plus any borrowing that hasn't taken place that's immediately connected to the actual buying of the company?
Yeah, so any debt assumed based on the transaction. Yeah. Not debt raised. Right? It's not the debt raised. It's not the debt raised to fund the transaction. It's the uses. It's the debt. It's the required debt that you had to pay down in order to buy the company.
The agreement that you have to take out the targeted
Yes.
debt.
It's the target's debts.
Okay.
We're analyzing the target. It's not the acquirer's debts. And again, we will flush that out better in M&A next week. Yep. So purchase price is 7003.6. And precedent transactions are sloppy. You'll see there's a lot of, everything's hard coded right in there. It's not as, because the data is so loose. A lot of things you'll see, NAs, you'll find information, but no underlying data. So anyway, market value, I'm going to hard code right in. $7,003.6. Price paid. And the enterprise value is that plus the debt absorbed, which they have right here, refinancing existing indebtedness and other retained indebtedness, 219.4, 67.7. I will use those. So the enterprise value is the year before plus 219.4 plus 67.7. That's it. And we use the market value and enterprise value numerators to calculate our metrics, but we need earnings, revenue, EBIT, EBITDA. So luckily when we scroll down, we already have an income statement. If they didn't give you an income statement, then you'd have to pull out the combination of K's and Q's and get your own LTM stuff. Did I pass it? No, here it is. You want the historical analysis. We are analyzing the target standalone prior to the acquisition. We want to know how much they paid for the company on a standalone basis. Not with the adjustments, not the post-transaction adjustments. We want historical. Net income, 137,943. You can maybe kind of quickly check if there's anything extraordinary if you want to clean this out, but they're not going to have extreme super detail. So 137,943 is the earnings. I'm going to take market value divided by 137.943. And I probably could have did a separate tab. You notice that when we did this, we had a separate tab for each transaction to lay out a mini income statement to be a little bit cleaner, but you get it, right? We did a comp. 137,943. Yeah. It's a high PE. You can see they're way all over, they're totally all over the place, and that's not uncommon. Revenue, enterprise value to revenue. They have revenue up top 9,169,822. So I'm going to take the enterprise value divided by 9,169,822. So 9,169.822. I'm rounding the decimals. I don't know if I mentioned that before. 139.943. 9,169.822 to be in equivalent units, millions. Okay. Next, what do we have? Operating profit. That's basically our EBIT. I know DNA is buried in there. So this is our EBIT effectively, 248,276. I'll later have to dig up and add back DNA to get to EBITDA. So 248,276. So I'm going to have EBIT is going to be enterprise value divided by 248.276, 29.4. 248,276. Yeah, just matching. Looking good. And so EBITDA, I need to do a word search, try to dig up some depreciation. And here is depreciation here. Want to be careful to make sure it's the same time frame, which was this February 2nd, 2007. They have depreciation of 200.6. So we had EBIT of 248,276, adding 200.6 gives us 448.9, and actually you can see right here EBITDA, they give you right there 448.9. So they actually, so this gives me a little confidence that we're pulling in the right numbers. We had 248,276 of EBIT plus their 200, 448.9. So I could have taken the 248, added the depreciation. I'm just going to pull this number 448.9. Same thing. That's their EBITDA. So I'm going to take enterprise value divided by 448.9. Precedent, at this point, precedent transactions is more about digging up numbers. So I don't want to get too much into it, and that's why I'm just doing it on a quick way. really the daunting part is it's not so complex. It's just digging up, read the research behind it, and digging up the numbers. AJ.
In terms of like the transaction details, is it always the firm that bought out the other one first and then the target company next? The way it's right now?
Yeah, acquire/target.
Okay.
Yep. Acquire/target. Yep. Okay. What does this say? So, enterprise value earnings is all over the place. No surprise. You can look at revenue. Obviously, better to look at EBIT, EBITDA. In this EBITDA, we are getting a bit of a range, 12 to maybe 16. It's not so bad. 12 to 16. Not so crazy. We had 8 to 11 for comps. I'm trying to think of what I used in the book here. I used 12 to 16. It is higher than the comps analysis. Is that expected? Because it includes a premium. So even though this is 5 or 6 years previous, I'll at least put it in and look at it, but know that the analysis is dated. Might want to discount it a little bit, or even just throw it out altogether. So that implied range will go into our kind of football field analysis, where we have a precedent transactions, low of 12, high of 16. This can be tweaked. And we want to back into an implied share price based on that low and high. So if the EBITDA, got to assume the same EBITDA across the board. If Walmart were to be acquired for 12 times, what would be that acquisition enterprise value? $400 billion. What's the implied equity value? You subtract the net debt, 364, divide by shares. At what purchase price per share would they have to pay? $108 per share. That's an implied value based on the precedent transactions. We will do the same at 16 times. Same idea, back into those numbers. Let me know if you have questions. Whoops. 108 to 149. Question on that? We'll also look at the discounted cash flow analysis. Now, we could have done a few things. We could have run some sensitivities. We'll deal with sensitivities in LBO. We would do sensitivities around the larger of the variables, namely the EBITDA method multiple. Now that we have a comps range, we use the LTM 8.7. We realized the range was 7 to 11, so we could have said, well, what's the actual implied price if the multiple is 7 versus 11 to extrapolate a better range of dollar amounts. We could have made an adjustment to the WACC. Our beta could fluctuate. We'll dig deeper when we value Hines and value Office Depot, Office Max in the LBO, M&A and LBO courses. For now, and just to match within the book, I took this number as the low and this number as the high, 88 and 96. Okay, so I think I even just linked it in, didn't I? So I took football field, the low price is based on what the output was from the low end of the DCF analysis. And the high price from the high end of the DCF analysis. And backed into what the implied EBITDA multiple is. So again, what I really would have done, I just didn't want to get into it in the book, is create sensitivity analyses for each. An EBITDA terminal value sensitivity to variable table, a perpetuity one, and just got a better range. Got a better range. We'll talk about how to do that. Maybe not for Walmart, but for other companies. And so, like what I did for the low-high 52-week high, I'm going to back into what the implied EBITDA multiple is. So I'm going to take the share price and multiply. So at $88 a share, their equity value is $297 billion. Add the net debt to get $349, and then divide to get the implied multiple, 10.1. Not too far off from the comp slope. Pretty good. And do the same on the high side, where I'll multiply, add to get to enterprise value, and divide to get to 10.8. So range is a little tight. I would like to extrapolate that range. And what I would do then, and that's why I'd run some sensitivities. And let's see, maybe we'll have time to do it on Walmart today. Let's see. But just to match the book, this is what you'd have, and when you'd scroll down, this is kind of what you'd get. Is it 73.82? I want to make sure the line is where they're currently trading at. I lost my axis. Yeah, no, that's not 73.82 because we have 100 here, so the line needs to drag down a little bit. It needs to be way under here, 73.82, even under here. That's about 73.82. This is where they're trading at. Okay. What is this saying? What's that?
That it's undervalued.
Maybe. Why would you say it's undervalued?
Because all the bars are above the line based off of the valuation measures.
Break it down though, instead of just bars. What's each bar represent? What does it mean? Interpret it for me.
Alright, so for the first one, it's saying that we're almost near the 52-week high.
Yeah, and they were at the peak. They hit that like within days of this.
Right, but based off of the market comps, it's saying that there's additional, probably 20.
These are the comps.
Yeah, an additional $20 that can grow.
Okay.
The precedent transactions, so it's 150, but
Okay.
you know that's not necessarily reliable
Why?
because the information is outdated.
Outdated. Yep. This could have been maybe in 2009. Maybe everything would have been up here. Okay. What about the DCF?
And the DCF is again close to the market comp, so the range is 96 to 98.
What would you believe in more?
At least that's the high range.
Mm-hmm.
But then you also have the low ranges as well.
Uh-huh.
Which one would I believe in more?
Yeah.
I'd probably weight it at 60% towards market comps and the remaining 40 at DCF.
And what's the benefit of believing in the DCF versus the market, the comps, and vice versa?
DCF like factors in intrinsic value versus market comp, where it also factors in the systematic risk portion of it.
Yep. Yeah, the DCF is based on our projections, which is theoretically more technical, especially if you build a conservative model and it's still higher. This could be a good indicator. The drawback is this is also based on a lot of broad market assumptions like WACC and growth that may or may not be true. Whereas this is based on the market. Drawback here is we don't know if these are the right comps. All in all. So this was a tough situation to analyze. Now, again, when I ran this analysis while putting together, this line was like way down here, right? It was at the bottom. And it was clear to see that it was going to go up. At this point, it was a little bit difficult. And if we have time to extrapolate this, we'll see that the bar just kind of pulls down here. So it does fall in line with the comps, which is supportive. It's nice to see a DCF that supports the comps, which means the market is supporting where the company's expected cash flows or the present value of the company's cash flows are based on being. But the problem here is, even when we extract it, the line, they are within the range. It's just a matter of they're at the bottom of the range. Will they rise to the top of the range, or will something change in their earnings expectations that'll reset the whole model? That's the thing that you have to start analyzing. And what ended up happening was, which I think I put in the book, because I thought it would go up a little bit, and then we'd have to reset and see, and it did go up a little bit. It went up to like 83. And then when you redo the analysis, you'd see that they were at the peak, and then they start to go back down. But yes.
So the price target range for DCF is, is a lot lower than the price target range of market comps. I mean, we're talking about almost a $30 swing there. Like, is there a way to, what's the best way to reduce that?
The DCF?
No, the market comp.
Is, you mean 70 to 100?
Yeah.
Get better comps.
So if you see a wide range like that, is that indicative? You just need better comps, or?
I actually would argue that this is too tight.
That's too tight?
Yeah.
What's the range?
Well, so what did we do on a multiple basis? We did 8 to 11, 3 points is pretty good. 10.1, 10.8 is too much. 3 to 5 point spread you want. So this is where I'd go into the DCF and run maybe a little bit more solid sensitivities to try to extrapolate. Let's do it now. Come on, let's have some fun. All right. So the EBITDA method is based on what major variable? You guys done two variable data tables?
Yes.
Yeah. What are the major variables here?
We have WACC.
The WACC for the EBITDA and the terminal multiple. Let's do that. Let's do EBITDA method. Okay. And based on the EBITDA method, we'd want a stronger, we want to see how the stock price can fluctuate based on two variables, adjusting WACC and adjusting the terminal multiple. So in the upper left corner of any two variable data table, we want a link in to what we want the table populated with. I want the table populated with varying stock prices. How much could $88 move? Okay. To the right of that is a series of inputs. Let's make that the WACC. How can the WACC fluctuate? WACC is that?
Based on the beta.
Based on the beta. And what would happen to beta? We're at 5.16%.
So higher the beta, higher the
I would argue the beta would probably, yeah, let's see if the beta goes up. 0.4, what if it's 1? Goes to 8. I don't think it would go above 1. So I'd fluctuate the beta from 5 to 8. So I'd say I would do 5%, which it is about now. I'd do 6.5%. And I do 8%, maybe. I don't know. Well, let's see what would happen if the beta goes up. What about the multiple? How would the multiple adjust? What boundaries should we put around the multiple? Based on what?
Is this taking it from perspective or not?
Yeah.
Or we could look at it just historically what the company's done over, let's say, a 5-year period.
So you could do either the comps, or you could do the 52-week high-low. 52-week high-low was 7 to 9. Comps was 8 to 11. You could do 7 to 11. I would do comps, 8 to 11. I don't know. I think this is a bad low for them. And we actually, how many years later it was they haven't gotten back to that, although they're close now. I would do 8 to 11. I would do the comps. So let's go back. Would I miss it? The DCF? I would do 8x, 8x, well, 8, 9, 10, 11. Okay, you guys know how to put the X in? We'll do a class on VBA and custom formats. Just go to Control 1, opens up the box, of course, go to custom. I'm going to do type 0.0x. Real simple. Right, if you type in 8x, it's going to read it as a string, and it won't make calculations off of it. Then you can highlight the whole table, including the upper left corner. You got to have that there. Right? Got this so far? Alt DT, right? Alt data table, or data, what if analysis, data table. It asks you for 2 inputs. Row input cell, right? Of the variables across the row, where do I go in the model to impact a change in that variable that will change the answer? Where do I go? Row input cell. The WAC. The WAC up here. This is what drives the change in WAC. Column input cell of the variables up and down the column. Where do I go in the model to change that variable? Terminal multiple. Okay. What happens? There's my range in prices. I'm going to format that into dollars. So 70 to 112, I'd need to narrow this. This is too much. But okay. Everyone get that? This is an example of how I would do it. I'd probably tighten this. Maybe the 5 is too low here. Maybe it should be 5.5. I could just overwrite this to bring this down a little bit. Maybe 11 is too high. You know, I mean, you kind of make some logical conclusions here. 70 to 90 is more appropriate. You know, you would. And basically, we're at a high of 96 already. So maybe, well, I'm basically extrapolating that maybe the stock price can go down a little bit more if their volatility goes up. Volatility goes up, beta goes up, WAC goes up, stock price goes down a little bit. You see a little bit more volatility, a little bit more risk in that stock. That's what this is saying. You might want to give a little bit more breathing room to the low end of that stock price. It could reduce a little bit. It's one way I'd interpret this sensitivity analysis. So if I had gone to the football field and said, all right, well, maybe this was around 70, which gave me an implied 8.3, maybe that's what I'd see. You know, that makes a little bit more reasonable sense to me, depending on the nature of the cash flow. This is the art in the valuation side of the analysis, and this is what's tricky for a lot of people. You gotta kind of guesstimate what a range will be, and this is subjective. And remember, you're just kind of getting towards supporting some sort of acquisition price for a potential investor. That's really what you're getting towards. Still pointing towards what AJ was suggesting, that there's still a lot more room to increase, but how high would that go? And I believe I concluded the same thing. There's a little bit more to increase. I don't believe in this. I didn't know how high. I think I might have said I didn't really hit 90. It hit about 86, and then started to decline again. But again, the point is you want to great when you see clear-cut opportunities and now across the board, no matter what sensitivity you put, it all points to the stock going up. Those are the investment opportunities you want to look for. And in this case, I'd kind of almost say, it's a wait and hold kind of situation. But this is the point. And this is also the point when a lot of people get confused when they put on their resume, I value the company at, $67 to $98, or I do $277 to $380, based on an 11 to 10 times EBITDA, an 11 to 13 times EBITDA multiple. It's not the terminal value multiple. It's the overall multiple that ties to the range of your valuation. And so a lot of people put the multiple meaning the range of terminal value. It's these multiples. It's the multiples that you're using to establish a range of value, because then someone's going to say, all right, well, you valued the company at 380 to 416. What EBITDA were you using? And you better say 34 billion. If you said like 50 billion, the math won't work. And they're looking to make sure that your numbers tie. So just make sure you're updating that. Any questions on this stuff? No? Kind of have this? I'm going to put this back to the 88 because that's what matches the book. You okay with the variable data tables? You want to try the next one on perpetuity for practice? Are you guys okay with it? You good? We'll focus on the more in M&A and LBO. Okay, we're done with the model. We're done with Walmart. We want to start transitioning into M&A, but first, I do want to. We have limited time, but I definitely want to get into this. I sent you guys the file on calculating betas, yeah? Do you have that? Let's get into that quickly. It is good to know how to calculate your own betas. And I have, just want to pull it off the cloud here. There it is. Great, okay, I'm just downloading it, and it is downloaded. So, yes, edit. Let's say I have a series of, data. Oops. Right. And let's say, oops, I have downloaded, and you can do, what did I do here? Sorry. You could do 1 year, 5 years, 10 years, X years, and the first thing you would do is go to Yahoo Finance or Google, and you would download, I think I did November 10th, 2014 so I did 20 years of data. Be interesting to see how close this lines with the data that we pulled, the 0.46 that we pulled from Bloomberg. Sometimes it's off, or we pulled from Yahoo Finance. And so the first thing you want to do is calculate the daily returns, right? Because you have to calculate the variance and covariance, the beta off of the returns, right? So I'm going to do SP 500 percentage, daily return, Walmart percentage, and that's going to be equal to this year divided by the prior year minus 1. And the same on the right. I'm going to get a percentage. Maybe I'll add some decimals. And I'm going to copy this all the way down. Yeah? So the quickest way to do this is if I copy these cells, Control C, and I'll start from the bottom. So if you want to, you might be familiar with these hotkeys. If I do Control arrow down, it drops to the very bottom cell. That'll only work if I'm highlighting a row with information on there. So I've copied the formula. I've gotten to the bottom here. I'm going to go to the right. This is where I want the formula copied to. And while holding down Shift, tap the right arrow. While still holding down Shift, hold down Control, arrow up, and then I can paste everything. Quick way to paste everything. I'll do it again. So first of all, I did today divided by yesterday minus 1. And I copied to the right. And I highlighted both columns. So Control C. So that those formulas are copied. I want to paste it. Yeah, I think most people would just scroll down, and scrolling down is going to take you forever. And maybe you scroll down too far and scroll down. Just go left one column, because if I hit Control arrow down, it'll go to the very last cell. So Control arrow down will take me to the last cell. Okay, Control arrow down. And then I could tap the arrow to the right, because this is where I want to copy to. And now while holding down Shift, tap to the right, so that highlights both columns. While still holding down Shift, hold down Control and arrow up, takes me back up. And then I can Control V, paste it all in. Now I have my returns, from which I will calculate my beta. And so I would say I have my, I forgot how I laid it out, years and beta, very simple. So I'm going to have years, beta, and what I'll do is just to do, I think it was the count formula, I'm cheating a little bit here, but I have, yeah, okay, very simple. So I'm going to, just so I know I'm on the same timeline, I'm going to count the years. I'm just going to do equal to the first date minus the last date. So I'm going to go over to date. I'm going to hit Control page down to get me to the last date. And I'm going to put parentheses around this formula. Divided by 365 days. That's going to count the years for me. There are other ways to do that. Yeah, it should be. I think I made it 5035. 20 years. And I'm going to round this to the actual number, so that's close enough, 20 years, right? Okay, I just start date minus end date divided by 365, number of years. And then I'm going to calculate the beta, which is the covariance. So I'm going to use the formula, COV, there it is, covar. Why does it have an exclamation point? I hope it's going to work. Okay, is it telling me that I can't do it? Yes. Covariance of, and I'm going to highlight everything, S&P 500 from today, colon, give me a range, Control page down to the end, right? Covariance, I selected B2, colon, we'll start a range, Control page down, gets me to the bottom here, Control arrow down, gets me to the last cell, covariance of that, oh, and I got to do it on the percentages, I'm sorry. I got to do it on column D, not column B. Okay?
Column D?
Yeah, I have to do it on the returns. Comma, in line with Walmart. Oops, so I'm going to go E2, semicolon, control page down, E5034, right? Divided by the variance, right? This is the formula for beta. It's the covariance of the asset versus the market divided by the covariance, divided by the variance of the market. VAR, variance. And I'm going to select the range of the market, which was D2, colon, control page down, D5034. That is the beta formula. There might even be a beta function. Okay. Good? Which gives us what? A crazy number. Let's round it. I'm going to round it to 2 decimal places. All I need, 0.73. Much higher than 0.4.
You go back to the debate on this.
Yep. Then I want to do it for 10 years, then 5 years, then 2 years, then 1 year. And see how it changes. Is it more volatile in the near term? Is it less volatile? You can maybe average it all, or you can use these as your basis for varying the WACC when doing your sensitivity for your DCF valuation. Just getting into more detail. Okay. So for the next one, I want to do 10 years, and I'm just going to cut this in half. So actually, what's 5034 divided by 2 is 2517. So I'm just going to take, these formulas, I'm going to copy them, so I'm going to highlight them. I'm going to paste them. I'm going to divide it in half. I forgot what the number was. 5034 divided by 2. Cutting it in half is going to give me a 10-year analysis. So it's 2517. So I'm going to go, all right, 82 to 2517, I'm guesstimating it's going to give me 10 years. Yeah, it will. So I'm going to copy the beta formula. Just going to highlight everything, paste it. I'm going to change everything to D2 to D2517. So instead of 5034, I'm going to do 2517. And I can replace, if you want to do it quick, 5034 with 2517. Uh-oh. But I don't want to do that. I want to undo. I can replace only in the cell. I want to replace 5034 with 2517, but just in this cell. Okay, it's not going to do it. All right, fine. I should have started the cursor before, but that's right. 2517, 2517, 2517, and that's the 10-year beta. 53. It's gone down. Here's the formula, yeah? And you keep cutting it in half, right? I mean, pretty straightforward. This is good to have. Yeah, to calculate your own betas. Divided by 2 again to get a 5-year. 12585. Okay, I'll do 1259. I'll just make sure that makes sense. Yeah, 1259 should be 5 years in, so it should be November 10th, 2005. Let's see. I mean, 2009. 1260. Right, so it should be 1260, November 10th. 1260. So I'll do the same thing, but for 1260. So copy the formula. And I'll do 1260. 5 years. And I'll do 1260. Right, 1260. 1260. And 1260. So that's the idea. And you can do it, same thing, you can do 1 year betas, you can do, it's funny, the volatility is going down. Why did that not? Fine, 5 years. You can do it for 3 years, here's 1 year. So this is what we had about 0.42, but I might say, well, let me do a sensitivity. Maybe my sensitivity shouldn't have been as high as 1, maybe it should have been as high as 73. It's funny that it gets less volatile as we get closer to now. Say it again?
Isn't it normal for it to be less volatile if you're taking a shorter time period so there's less up and down movement?
I don't think so. I think in the near term, Walmart was more volatile. Their stock was swinging more. Let's see. Actually, I have the whole solution here. That came down, started going back up a little bit. It depends. So I can send you this. But that's how you calculate your own betas. Any questions on this? Okay, so that's it for valuation. Although valuation won't go away because it's going to be utilized in M&A and leverage buyouts. It's going to be an important piece. There's a valuation exam scheduled for what? Not till, okay. It's in a while, right? Yeah, so you have some time to study for it. It'll be 2 parts. It's a case study. It was a Goldman Sachs case study, but I kind of made it more like a test. The case study is meant to be open-ended. I made it closed. There's a specific answer. Part 1 is going to be Q&A, 5 questions, just like yesterday's test. Part 2 will be a analysis you have to do on paper. It's a DCF analysis. On paper. I tried, but you guys cheat. Gotta be on paper. Punished. Yeah, gotta write it out. And we'll do a couple on the board. Notice in the schedule there's some like interview prep stuff, like more soft stuff that's gonna come now. Tomorrow Julio's gonna teach. He's covering for me because I gotta do a presentation in Boston. But he's doing a good private equity M&A intro. It's more case study based. It's good. On Thursday, we're going to get into M&A. I'm going to start by doing raising equity, raising debt. We'll do it on this model. I know I had scheduled for Thursday someone to come in. She does interview preparation. That's going to be pushed back till Monday. So a little bit of moving things around, but it's all going to happen. Next Tuesday, we'll do that Monster Beverages case study that was scheduled, which is a good one. On Wednesday, we're going to get into asset acquisitions, asset divestitures, and then we'll roll into formal accretion dilution analysis the week after next. And then we'll go hard with M&A. So it'll get exciting. Okay. Thanks, guys. See you tomorrow.